How can you as a business owner become more savvy about understanding the secrets that your financial statements tell you? Do you need a controller or do you need a bookkeeper? And how do you make sure that you don't get into one of two troublesome patterns? With that said, let's get into this episode of The Business Coach.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Well, welcome to The Business Coach. Today's episode, I've got a real treat in store for you. I brought on Rich Wood. Rich is not only someone who's a seasoned investor of companies, he's also someone who's built his own companies. He's a background of an engineer, an aerospace engineer who's been an inventor with patents under his name. He's built technology companies, he's built logistic companies, and he's coached hundreds of other businesses, all the way from small companies in the $1 to $5 million a year range to clients that are in the several $100 million a year range. He's a fantastic business coach who happens to be both a close personal friend and also the head coaching director for Maui Mastermind. So it's always a treat to bring him on. And in today's episode, when we bring him on, we're going to be talking about financials. Specifically, how can you as a business owner become more savvy about understanding the secrets that your financial statements tell you? What to know about who should be monitoring your financials at each stage and level of growth. You know, when you hit a certain revenue amount, you're at 5 to 10 million. Do you need a controller or do you need a bookkeeper? At what point do you need to go from a controller to a CFO? What about a fractional CFO? We're going to talk about how do you use and leverage your financial statements like your P&Ls, your aged AR, how to, a simple way in 3 minutes or less that you can create a forward-looking cash flow projection over the course of the coming year. To give yourself a starting point that does 80% of the work out of your accounting software to start with. We're going to talk about what do you look for in a balance sheet and how do you make sure that you don't get into one of two troublesome patterns that businesses get into, where they either get into a cash crunch because they don't use their financials the right way, or the opposite. They end up because they don't quite understand or trust. Their anxiety about their own financials causes them to leave too much of their own cash or capital inside of the business versus distributing it out, putting it at risk plus under performing for the owner. So we're going to get into the details with that. We're so lucky to have Rich Wood here today. With that said, let's get into this episode of The Business Coach.
Well, Rich, welcome to The Business Coach. It is a pleasure to have you joining us here today.
Thank you, David. I'm excited to be here, and I'm excited to share whatever insights I can.
Yeah, and as you know, in The Business Coach, we get a chance to talk with, several thousand business people out there, and we come from the frame of, the two of us or other coaches that we bring on. We're people who've got a chance to work with hundreds, or in some cases, thousands of businesses over the last 10, 20, 30 years, and we're trying to share experience that's about that. But the place I want to start with this conversation here today, Rich,
Sure.
What was the first business that you ever ran? I know we're going backwards in time. I'm not going to date either one of us. I won't do that. I won't be indelicate. But give us a quick story about the first business you ever ran, briefly.
Sure. You are testing my memory a little bit. So if I look back several decades ago, the first business that I started was in a high-tech industry. I have an aerospace engineering background, so I started my business in the aerospace industry. And what I laugh about as I look back on those days is how naive I was with the concept, the silly notion that if I build a product or provide a service to the marketplace and I put it out into the world, that everybody's going to want it. That whatever I'm building or whatever I'm providing as a service is just going to be the greatest thing since sliced bread, that the marketplace will get it, they'll understand it. And that's not necessarily the case. I kind of look at it as the field of dreams kind of mentality. If I build it, people will come. And that was one big misstep on my part. Another misstep that I think was important was that I thought that I could do it myself. I thought that if I really want to build a business and I want to make the business successful, I'm a smart guy. I've got all of what I need to do. I had the business engineering with the engineering background, I had the business school background. I thought, you know what, I got this, I can do this. And that was a false illusion. I thought that I could do it by myself, and that's really not the case. So,
It's interesting. I'm smiling here. As I think about it, I mean, you as the engineering background, it makes perfect sense. If I take all my knowledge and technical expertise as a really good engineer, and I build this technical product that is really superior and gives some real demonstrable advantage, of course, the people are going to be wowed by the product.
took me a while to figure out that wasn't exactly the case.
Sure. And I was interesting. As you say that, I think that you represent a subsection of other very high cognitive, very high functioning thinkers, engineers, or other professionals that, kind of look at it that same way. And your comment about, I should be able to do this by myself. That's an interesting one. I guess I want to come back to this one. When you look at all the clients you've coached over the years, you've worked with lots of business owners. And I think I'm going to think about it from the same frame myself. I always like to ask a guest, what is a self-inflicted wound that you watch a business owner where they hurt themselves and they hurt their company by doing something where it's not the marketplace punishing them, it's not their employees punishing them, it's not any of that. It's not their competitors. It's they do it to themselves and they don't even notice they're doing it. What's something that you've seen where a business owner has kind of done it to themselves?
Well, there's really two, I categorize those as challenges, business challenges that a lot of business owners have, not just in the beginning of their business, but as they try to mature their business as well. I still want to come back to the Field of Dreams challenge. I think that's a common philosophy. That's a common pattern and challenge that I've seen in a lot of businesses. And the other one that I think is really kind of interesting is that a lot of the business owners think that if they have a positive bank balance, then they're financially strong. And I think that that's another big misstep that I've seen with a lot of the businesses that I've worked with.
Yeah. And so the Field of Dreams is if we build this great product, whether it be a software tool or whether it be a technical tool or whether it be a hard, lumpy object that's used to go prop up a side of a building. It doesn't matter. If we build it, that's not enough. We've got to find a way to still have a good sales funnel and marketing funnels and have these pillars of our business to promote and sell it. But the second one you talked about here is, let's jump into this one here. So how many business owners do you know, I see it, where they either they have or they don't have financials, but regardless of which, they're not even looking at them. They don't really know how to understand them. And as a result, they don't really manage profitability or their margins. They certainly don't manage their balance sheet, and they get caught in cash crunches because they don't manage cash flow. Speak to that briefly. Let's dig our teeth into that, because I think that's a really juicy subject for you and I today. I know it's a strength of yours, and it's something that I've had to make a strength of mine just for the businesses I've run and for the clients I've coached. But share about that, please.
Yeah. So fundamentally, financial systems, I think, are difficult for a lot of people that don't have formal training in financial systems or financial systems analysis. So it gets back to this concept that we'll talk about a little bit later, I'm sure, but it's this underlying pattern that you jump into something, you don't really have the background and the experience or the know-how, so you try to figure it out. You try to do it on your own. You watch a YouTube video or something like that. So you try to do it on your own without really recognizing that the path of least resistance and the path to the greatest success is to find the right people, to build your team, to strengthen the underlying foundation of your team with people that are well-grounded in financial systems, like a bookkeeper or an accounting person on your team, depending on the size of your business, that helps you get a strong fundamental foundation of financial systems built in place. And without that, then we're making decisions about the business. And this is something that I communicate to many of the business owners I work with now and in the past, is that if you're making decisions about your business without good information, without good data, then you're making ill-informed, misinformed decisions. So what you end up getting is you get bad results, fundamentally.
I'm going to just kind of riff off this for a moment. So you and I had shared some time recently at a workshop, and one of the participants at this workshop, one of our clients, a business owner by the name of Milt came up to me and talked, and he owns a professional services firm. And I had helped him. He had sent me over his financials probably 6-7 months ago, Rich, and I'd taken a look at them. And the way the financials were set up were absolutely wrong. They just didn't make any sense. So a professional service firm, you and I both know that they should look a certain way. For example, the biggest expense in a professional services firm is the professional work itself. So it's going to be a staff cost. If it's a medical practice, it's going to be your doctors and providers, your mid-level people, possibly some of your expensive nursing staff. If it's an attorney at a law firm, it's going to probably be your attorneys and your paralegals. And in this case, for him, it was he ran a particular professional service firm. There was nothing in there for cost of goods sold. Right. And then I looked at the other way things were lined up, and it just was clear to me that the person he had doing it was doing it in a way that was giving him inaccurate information, formatted it in a way that was going to be confusing and not really reveal the story. So I gave him some points, and you and I will talk through some of those pointers that I gave to him as direct coaching. Fast forward 7 months, he's fixed that through. He's increased his profitability by roughly $800,000 of additional profit year to date and growing. And that's from him having a better handle on, and you said it just right. You said it, if I don't know what really is going on, if I don't know the reality, if I don't know the facts on the ground as revealed in the actual financial numbers,
Right.
how can I make good decisions in there? He wasn't in the past making good decisions. He was measuring revenue because he could count that and put his finger on that and saying, oh, revenue was going up prior to us working together, but he didn't know how to measure margins or profitability. Talk for a moment about margins and profitability, because I think if we can start working on this deeper, I think people watching this, business owners who are part of this audience, I'm hoping that you'll take from this the lessons you need so you can avoid this self-inflicted wound. Rich, talk about margins for a moment, please.
Well, so the way I look at growing a business is really, it's not complex when it comes right down to it. When we try to grow a business, we try to grow our top line revenues, and we do that through implementation of a marketing and sales and advertising plan and a growth plan that's targeted specifically to our strategic business plan. But the other thing that we deal with is the gross margin. So a lot of companies think that gross margin, they kind of ignore gross margin in general. So they're not really paying attention to their cost of goods sold, whether it's a services firm or more specifically a product.
I'm going to pause you for a second there, because I want you to pretend I know what you're talking about. When you talk about gross margin or gross profit margin, I want you to pretend that you're explaining this to one of your kids, and just give us the 60-second definition of what it means by your gross profit margin, and then give us another 60 seconds to define this term that we hear, but we don't always know what it means, cost of goods sold. If you would, give it to us in a really simple way.
I'll take a step back. And so we have the top line revenue. That's the amount of money that comes into the business from the products or services that we sell into the marketplace. The next thing that we look at is we look at what we call the gross margin, which is the margin, the profits that we make after we've covered our cost of goods sold, the costs associated with delivering a service or developing and selling a product. That's cost of goods sold. Building the product, delivering it, getting it to marketplace, providing the service, getting it to marketplace. That's gross margin. So the gross margin is that key thing that we try to keep as high as we can, because what's important underneath that, it's below the line of the way I describe it, is if we draw a line at gross margin, everything below the line are the indirect costs associated with the structure, the foundational elements of the business, doing the work of growing the business, that all falls below the line. That's what we call our overhead. So we have gross sales, we have gross margin. The gross margin pays for the operations of the business. At the end of the day, after we subtract out the cost of growing and maintaining the business, we have our net profit. So what net profit is the dollars that go into your bank account, the business bank account at the end of the day, that you can use to pay yourself or use to do other things. So it's the bottom line is the net income number. So it's gross revenue minus cost of goods sold gets us gross margin, gross profit, if you will, minus overhead gets us net income.
That's fantastic. So it's kind of cool as you start getting to know businesses. We know, for example, professional services firms going to be running anywhere from we hope, a 35% operating profit margin, which is the net income. It's the profit after paying cost of goods sold, after paying expenses, but before tax. There's 3 different ways people call that. They'll call it operating profit. Some people call it net income. Some people call it owner discretionary income. All 3 are related. They're different ways of measuring profitability, but basically we're talking pre-tax profit. You're looking on a software suite like QuickBooks, it's going to show up as net income on the bottom there. It's pre-tax profit is from that. And so Rich, you make good sense with that. So if I have a construction business, I'm probably looking to see if I can't have that be 12%, 15%. If I can hit double digits in a construction company, I'm doing pretty well. And if I can hit 15+% operating profit margin, I'm doing really well. And to do that, your gross profit margin says, after I pay for my cost of producing my product or service, how profitable could I be is predicted in that, because the higher my margin is there, the more I have ability to still pay my other expenses and have profit. I like that. So coming back to this though, let's talk about this. Have you seen this? Like I noticed that business owners have probably 1 of 5 people does their financials if they have it. Either they or their spouse do their financials. A third-party CPA firm does their financials, a monthly write-up kind of contract with their CPA. They have a bookkeeper, they have a controller, or they have a true CFO who leads the financial team, depending on scale. So I just want to quickly touch on those, and I want to hear your comments about if this rings true for you. So I notice that whenever I hear a business owner does his or her own books, or their spouse does, that's costing them much more than a professional bookkeeper. Why? Number 1, it's time away from the business they could use to higher effect. And number 2, they're slower by far than a bookkeeper. Number 3, they probably don't do it very well. Has that rung true with what you've seen for a company? And I've seen people do it with a $500,000 a year business. I've seen people do it with a $5 million business, where they still control the financials themselves. Would you agree that costs them more than they ever would save by getting some qualified help?
Absolutely. It costs them. You pointed out the two key things. It costs them money and it costs them time. The time has leveraging impact on the business in a much broader way. The cost of money comes in a couple of ways. One, typically the family member isn't really astute or lacks the knowledge or experience in financial systems and financial systems management. The other thing that I've seen business owners do is that, well, 2 things that are related. One is they commingle their personal with the business, which is not a good thing. The other thing that they do is that they delude themselves or confuse themselves on what the expenses really should be. They hope and pray that it's something different, so they get positivity overlaid into the numbers, which detracts or distracts from the accuracy of the numbers, because they're not really paying attention to what the actual metrics are.
As I hear you say that, I'm hearing commingle, which, right, that's a no-no. We're putting all of our personal assets now at risk for that, because now we're going to have any kind of entity. My company or my LLC is going to have commingled. If I get into a lawsuit, they're going to pierce that very easily with that commingling. It's a big no-no. Plus, in any kind of audit or something, boy, my good friend Kevin, who's a CPA, he's going to say that since he has to defend people in audits, they do that, he's in trouble. He can't defend them very well. Your delusion or confusion will come back to. So the owner doing it themselves, probably not the way. I mean, I almost always will coach them saying, how can we get you to get somebody else to do that? The 2 big excuses I hear are, I don't have the money to afford somebody else, which is silly. It's pure crap, because, when they look at what it's taking for them, number 1, the bookkeeper would do it less than what they could actually sell or produce more in the business as a person in the business versus the bookkeeper themselves. And then number 2, they don't get accurate, timely information. And because of that, they make bad choices that cost many times more than the cost of the bookkeeper, probably.
That's right.
Second solution I see people go to is they go to the CPA, Rich. And my experiences with CPA firms, some of them do a great job on the write-up, some don't. But usually when you have a CPA firm doing it, my experience has been the owner gets the report emailed to them or delivered by mail. Usually nowadays it's emailed, and they just never even look at it. They just get it because they think they're supposed to have it, and they trust that the CPA is looking at it, and the CPA is not. Like the CPA is looking at to make sure it's accurate, but they're not going there to actually help you to make better business decisions around it. Now, many CPAs could do that, but would require that the owner sets up a formal meeting every month to go through, or once a quarter with them to go through. Hey, what do you think about my gross profit margin? Where do you think our pricing should be? What are you noticing on these trends? How are we doing cash flow wise? Have you noticed that when CPA firms tend to do it for clients, because the clients never take the extra step of interacting with their CPA on a regular ongoing basis about it, I find it's more expensive than a bookkeeper, and they get less value in it because they're not doing anything with it. Have you noticed that, or has it just been me with the clients I've worked with?
No, I've totally noticed it. And, it comes back to something that I'm sure we'll get into, which is the root cause of the problem. It's typically lack of understanding, lack of education on the business owner's part, not knowing what to look for, not knowing how to look for it, not knowing how to analyze the financial statements, and not doing it regularly enough or often enough on a regular cadence. So I try to work with my clients specifically to try to make sure that they understand the basic fundamentals of the the 5 key financial documents that I always talk about, to make sure that they understand what the documents are, what they're looking for, but more specifically, what the information is that they're trying to pull out of the financial statements to make informed decisions. But again, it gets back to the root cause of the problem usually is lack of an education and lack of awareness as to the importance of having the fundamental basics. And that applies not just to financial systems, but also strategic planning for the business.
Well, I'm going to build up, and we're going to come back to this idea of what are the key documents or what are the financial reports I should be looking at, the statements that make sense. How do I use them? We'll come back to that in a moment. I want to flesh out. I said there are 5 of these ways we get our bookkeeping done, assuming we have anything that is bookkeeping. The owner does it themselves or their spouse does. They hire a CPA firm to do it for them. The third is they actually have a bookkeeper. The strength of a bookkeeper, it's fairly cost effective. If you have a good bookkeeper, he or she will give you timely, accurate information. Right. But one of the big mistakes I see with bookkeepers is the owner of the business who doesn't have the background themselves can just trust that that bookkeeper knows what he or she is talking about. And most bookkeepers, they're a mom and pop. They have a business that generates $100,000, $200,000 of revenue a year, and that's it. That's their business. And so they see lots of businesses, but they really don't know how to grow it. And usually it's because their brain set is set. They're scared of something bigger. So I'll give an example. One of our clients I talked with, I want to say maybe a month-ish ago, is a bookkeeper. He runs about a $2 million a year construction company, which for a construction company is kind of in the mid-size. In the US, you and I know this, most contractors are under $1 million.
Right.
The mid-ground are somewhere between 1 and 20 million. And then so you start getting above 20 million a year, you're starting into larger ones. And some will be, very large $billion companies, but most in the country are fairly small. Anyways, his bookkeeper was saying, I'm looking at this one line item here, and you've spent, X thousand dollars, $40,000, $50,000 this year on this. You need to cut the expense. And our client was inclined to do that until he talked to his Maui coach. And the Maui coach said, wait a second, this expense is generating a huge return for you. It's what we call a strategic expense. If you cut it, all this revenue and profit's at risk. Not all expenses are equal. And a bookkeeper, if we're not careful, they don't really know the difference. They can see that, a line item went up. A line item like marketing or a line item like this. But marketing that works or third-party services that have great return on investment,
right?
Cutting those would be the dumbest thing you could do. And so I'm curious, can you speak to that? Have you noticed that some of your clients, when they don't really have the sophistication, there's a temptation where a bookkeeper sees it and they look at, especially on the expense side, all of it equal. Touch a little bit about not all expenses are equal and how we as a business owner can make sure that we make smart choices of what's a strategic versus non-strategic expense.
Well, that's a great question. I think what we're driving to is that gets back to the root cause: lack of awareness, lack of education, lack of understanding. And that's where I think a coaching program or a coaching team or a coach, a business coach, helps provide that broader perspective on looking at the numbers and evaluating the numbers. If the business owner doesn't have the background and awareness, then augmenting their team with somebody that can help in that area is a benefit. But I also see that there are different layering concepts of the process that are important. So depending on the size of the business might need a CFO or a controller. If it's a smaller business, oftentimes a bookkeeper is good. But accounting people typically tend to focus just on the numbers. And the business owner, I think it's important for them to keep in mind that the accountants, the bookkeepers, aren't looking at the business from a holistic perspective, and therefore don't understand the associated costs with developing a product or getting a product to market. They don't understand the concept of strategic investment. They're there to provide the numbers. They're there to give you insight into what the numbers are. They're usually not there to provide the business analysis that is absolutely critical for a business owner to make an informed business decision.
So building on that there, your bookkeeper is going to, if they're good at what they do, they're going to give you accurate financials that are going to basically help record transactions in a way that they fit accurately into your accounting.
Right.
Typically for a business, if you're certainly under $1 million, you're probably going to have a bookkeeper. You don't really need a controller. Somewhere between $1 to $5 million, the chances are you're going to start looking to get either a senior level bookkeeper or start to transition into thinking about having a controller.
Right.
And somewhere between the $5 to $10 million range for most companies, a controller. What's the difference? Again, I know you and I know this, but I want to share it with our audience. A controller think of it as a bookkeeper who now has more experience set of more complicated accounting systems to deal with things like more complicated depreciation schedules with inventory and can help make not just the straightforward transaction recording of what's in a P&L and a balance sheet happen, but can look at things like the collections processes and can do good things about getting great financial strength in the core financial pillar, but they're not going to give great analysis. They're not. They're going to be able to give you more sophisticated information that the owner asks them for, but they're still not going to have the same business judgment. Certainly between 10 and 20 million or above, a CFO is probably something you're going to move into. Right. CFO, your chief financial officer might be full-time. Probably don't need a full-time CFO even at a $12 million business. You're probably going to think about that as a fractional CFO. You might want a quarter time of a CFO or a sixth time or a half time. And somewhere on your way to 30 and 50 million, you'll transition over. And a CFO is going to have a controller underneath him. And that controller is going to take care of all the financial stuff going on. But the CFO is going to give you the ability to now look as a business thinker, as a financial thinker looking forward. What would happen if we raised pricing? What would happen if we made this? What should our return on investment and our payback period be for making this choice here? How do we make sure that decisions made in other departments are being done with some financial rigor, that someone's looking for the return for the company? This is a good thing for a company, but for most people, if you've got a business that's 5 or 10 million, you're going to have a bookkeeper into a controller. From 10 to 20-ish million, you're going to probably have a controller with some kind of fractional CFO. And then over 20 million, you're probably going to have a full-blown CFO somewhere in that mix. So hearing that, Rich, come back to it. You said most important financial documents. I'm curious what you're going to say for that, and I'm going to compare it to what I would say. And let's say when you're working with a client, would you tell them that out of their accounting system, what would be the most important financial documents they should look at? Then we'll get into how do they use those documents after that.
Right. So I think that those are great questions. So the 5 financial documents that I think are the fundamental documents that have varying levels of emphasis in what we look at and how we look at them. So first and foremost is the financial statement, the profit and loss statement. There are a lot of different people out there. Some people will call it an income statement. Some people call it profit and loss statement. But fundamentally, it's the basics. It gives you the basics of what we talked about: revenue, gross margin, operating overhead, and net income or operating profits. So that's fundamentally what a financial statement will give you. And it's important to look at that. I encourage business owners to look at that on a regular basis every single month to understand where the numbers are today and how they're stacking up against a budget and a forecast that hopefully the business owners have created. So that's number one. I think that gives us the biggest source of information for making sound financial management decisions. The other important document that's really that I think is critical for business owners to pay attention to, and it's accounts receivable, and more specifically, the AR aging report, which tells us how much we're invoicing, how quickly we're collecting, and how that collections turns into cash flow for the business that we can use. So it's AR aging, which gives us insights into what's getting invoiced and what's getting collected over time. And there's a big risk for business owners that they should keep in mind is that once you have AR aging that goes out past 60 and especially 90 days, the longer that AR aging is sitting out there, the higher the risk is of collecting it. So that has a huge business impact. The third document is the AP aging, or the accounts payable. So the AR aging is how much money is coming in. The AP aging is how much money is going out to various suppliers and vendors and other components of the business that you source things to run your business with. So it's AP aging. So one is cash in and the other one is cash out. So knowing where your cash is going on a regular basis is important. And I'm a big believer in trying to leverage your AR and your AP against one another. So slow the AP down to a degree and accelerate the AR to a degree. So get your suppliers and vendors to effectively finance some of your cash flow as you accelerate AR to bring the cash in faster. So it's one kind of basic trick that we can use in financial management. And then the next document is the forward-looking forecast of cash flow. So it's a cash flow forecast. And I typically like to see an 8 or a 13-week cash flow forecast, which in simple terms is you're balancing your checkbook. Well, a lot of people don't balance their checkbook, but a forward-looking cash flow statement is effectively looking at where the cash is coming in and where it's going out. And there's some complexities associated with that, but simply said, that's really what it is. And then the last document, which is something that is a living document with the business, it's the balance sheet. So it represents the health of the business on an ongoing basis, year to year. And that doesn't change a lot from one month to the next, but it's important to stay on top of the balance sheet because that's where we look at the variability of our assets and the variability of our liabilities that ultimately generate net equity in the business.
Rich, this is such important stuff here. We're gonna tilt our conversation today. I know you're going to come back as a regular guest on the Business Coach at various times, so I'm going to get the chance to ask some other questions. But I want to stay with these financial documents. You know, the P&L, the profit and loss statement, also called the income statement, gives me that here's the money coming in, not money. Here's the sales made. Got to differentiate that. Here's the expenses I have. And the thing that gets people into trouble with this is that we think it should be common sense. Oh, if I have a sale, it shows up on my P&L. But many times you have money going in, many times you have money going out that don't show up on a P&L, but it does put money into or take money from your bank account. And this is the weird part. And I have to tell people that, look, even if you don't agree with this, there are reasons why financial accounting standards are set up this way. It's like a game. It's like 90% overlaps with common sense, but that last little part that doesn't gets you into trouble. For example, you know, we have a manufacturing client. He has $1 million of manufacturing equipment. You know, he might make a $18,000 payment this month on his equipment. Of that $18,000, $8,000 might be interest. $10,000 might be paying down that loan, amortizing that loan. $8,000 of interest shows up on his P&L as an expense. the $10,000 of principal pay down doesn't show up. It actually shows up on his balance sheet because I've taken cash and turned it into more equity in my piece of machinery.
Right.
But it doesn't show up in a P&L. And so it screws people up. Things like payments like that, or the other. Some people I've talked with, Rich, that they'll have their accounting, and there's two different versions of doing a P&L. There's, we call cash basis or accrual basis. Cash basis says when money goes out, we record it. When money comes in, we record it. Accrual says we try to match up the period at which the income is for and the period for which the expense is for. We try to match them up. So if somebody gives me 20 grand today as a deposit for a $100,000 piece of work I'm going to be doing down the road, on cash, I got 20 grand of income coming in.
Right.
On accrual, that $20,000 deposit does not show up on my P&L until I actually produce the work and deliver it. It shows up on my balance sheet as a liability, a deposit I've taken in for work I have to produce. You know that, I know that. So what I often will tell my clients to do is I'll say, look at your financials in your software. Most of them are going to use a software. If they're under 10 million, they're probably using a QuickBooks. If they're over probably 20 plus million, they might be in a more proprietary, more advanced accounting software system. But let's pretend that they're on a simple one. They can look at it both as a cash P&L and an accrual basis. And I want them to look at both. And I want them to ask their controller or their bookkeeper every time they notice something significantly different, or even better, talk to their coach. Why is it that my income for this month shows a $280,000 on cash, but only shows $240,000 on accrual? What's the $40,000 difference? And that, for me, was the way that 25 years ago, I learned how to really understand the story inside of cash versus accrual on my P&L. You have any other tips or thoughts as you hear me say that sparks for you about how to more effectively, in a more sophisticated way of using your financials? Again, we're just talking P&L right now, just P&L.
Right. So first off, I would say that the concept of accrual versus cash is a difficult concept for most business owners to relate to. And it recognizes a need for a more sophisticated level of understanding about those financial statements and about how to use cash versus accrual, or more importantly, how to leverage the balance sheet with the profit and loss statement to effectively run the business on a day-to-day, month-to-month, and on an annual basis. But the balance sheet and the P&L, there's this other layer of tax strategy planning that comes into play as well. So it's important to understand the nuances of accrual versus cash and how you can leverage the balance sheet and the profit and loss statement to effectively manage your business. But again, it comes down to variability in the types of industries that you're in. The size of the business is important. And more specifically, there are differences of accountants that specialize in manufacturing accounting that is different than a services-oriented business that only provides a service. So I think it's important for the folks out there to understand that you should have an accountant if you're outsourcing your CFO function or your accounting function, that you're outsourcing it to somebody who has got domain experience in your business market segment.
That's important. Yeah, and just for people who are listening or watching this right now, generally speaking, if you're having some kind of inventory in the business, almost always you're going to have to be on an accrual basis, or at least on a modified accrual basis in some version, just from a tax compliance standpoint. And 8 times out of 10, you're probably going to have a little bit of tax savings, especially for my service businesses that are part of the audience, by being on a cash basis. Generally speaking, you will. But as you mentioned, Rich, a conversation. I know when I talked with my tax strategist years ago, he and I went through my business and we looked at one of my businesses is better on an accrual basis from taxes. The other, I will end up being better on a cash basis. So we made those elections and we've followed that consistently ever since. That's a good conversation. One of the things I'll mention for me, and I'm curious, again, we're looking for little tips or tweaks to help somebody use their P&L in a more effective manner. Like I'll go through with a client and I'll say, look, let's look at your P&L, not just right now, but let's have a snapshot of now, year to date, perhaps, and let's look at it like previous year to date. That's a memorized report that you can pull this year to date versus previous year to date. You can easily pull that without having to do extra math. And when I look at that, I'll say, look, do you notice that your sales increased by 15%? We can just see that revenue went from $1 million to $1,150,000. That's a 15% increase.
Right.
But do you notice that your cost of goods sold only went up by 5%? That means that, look down here, your profitability, all things being equal, is greater. Your gross profit margin improved. So I'll oftentimes walk an owner through where they'll see if sales have gone up or down, look at the percent they increased period one to the old period, and then look at what did your gross profit margin do that period to the old period? What did your operating profit or your net income look like one period to the other? And if something went up by 15%, I want to see, what happened to those other margins? Because it gives me really good information. If revenue went up, but profitability went down, where was the drain? Was it at the level of maybe my gross profit margin decline? It's costing me too much to produce my product or service, or my pricing is off relative to my costs. Or maybe it was below the line, and maybe I had a new expense. Like I'll mention this, Rich, just literally 2 days ago, I was talking with a client, and he had shared with me, we looked at his profitability. He had a decline in revenue slightly. We're talking single digit decline year over year, but his operating profit was down by over 50%. I was like, we need to dig deeper to know why. And it turned out that he had made some major purchases on a cash basis for things that really probably are going to have to be depreciated over time. He got a new solar system for his office building, and he bought a brand new car inside the business. And so when we looked at that, I felt better that these weren't structural things that meant that the business needed to make adjustments. They were simply cash flow decisions that he made that he felt good about. Any other tips you can share about using the P&L?
Yeah. So the thing that I like to look at, and first off, I just want to just touch on the comment or the point that you just made. It's important for the business owners out there to understand that there's different ways that you can incorporate expenses. You can put them in your profit and loss statement, absorb the expense in any given month that you incur it. Or if it's something that can be amortized over time, you can put it on the balance sheet and bleed it into the profit and loss statement on a monthly basis, which helps cash flow, and it helps even out the numbers, and it will help your tax strategy planning process as well. So I think it's important for people to understand that you can make a decision one way or the other that has a different impact on your profit and loss statement. So it's important to understand, to ask the right questions of your coach or your CPA or your CFO or your bookkeeper.
Certainly. And some of that's going to be dictated by what the tax code's going to say. Some expenses I have to depreciate over time. Others I have a choice. Keep going though, Rich.
Exactly. So that I just want to touch on that point, that it's important to know enough to ask the right question. And this is something that we would probably talk about at another point. But the other thing that I use the profit and loss statement for, I think that you mentioned looking backwards to see what the pattern in profitability and revenue has been over the course of maybe the last year or perhaps the last 2 years. But the other thing that I think is really critically important for business owners to do is to develop a financial forecast for the business, especially going into the beginning of each calendar year, but have a financial forecast that you can adjust and look at, because the financial forecast allows us to look at where we see revenue coming in, how we see variability of products or services in cost of goods getting applied that affects our gross profits. But more importantly, it allows us to develop a budget that we can track that helps us manage our overhead costs. And I think that not having a forecast and not having a budget for a business is a very big challenge, because you're not proactively managing your business. If you're not doing this, you're reactively managing your business, and trying to manage a business, minute by minute and day by day is not a very effective way to do it.
Yeah, it's interesting to hear you say that, because then I get clients all the time say, well, how do I go about doing it? And I say, well, I can tell you in 3 minutes or less how to start that process. Number one, take your P&L for the prior, like in January, when you have your prior year, take your last year P&L, get it put out by month. That's a feature of any accounting software that can give you your P&L by month.
Right.
Export it to Excel, which is a function of the software. Nothing extra needs to be done. And now that gives you your template. These are the income and expenses that you had the prior year. And that's 80% of my template. From there, now I got to ask myself the question, well, I know I'm going to have more cost in here because I hired a better quality person. That's another $40,000 per year above what I paid for this function. I know that I'm planning that I think that, if we grew 20% last year revenue, I think we can hit 20% growth again. So I'm going to make the adjustments. You can go in then and tweak those numbers, and you've got a 12-month forecast. And then every month I look at what my actual is to the budgeted, my forecast. What's the difference, called the delta? Software can do this for you. Then I now go back, do I change any of the other months based on what I'm learning? I thought I was going to have a 20% growth, but I'm at 25%. I should probably up my forecast for revenue in these other months, I believe. Or I'm only at a 10% increase. Is my 20% increase still valid as a target? Right. And so just starting with what I already have from my prior year, exporting it month by month gives me a starting point. Because otherwise, Rich, I don't know what you've seen. I see clients, business owners all the time that just get stuck. I have no idea where to even get started. Well, in your financials, you've got all the categories that you could consider.
Right.
And we probably simplify. I don't worry about forecasting it. If I've got expenses on there, and I see it with financial P&Ls that go down like 3 or 4 pages down. And I'm like, wait a second, why do you have so many categories? You've got a separate line item category for expense X that's less than 0.01% of your revenue. Bump it into somewhere else. There's no reason it has its own category. You're making it overly complex, which many bookkeepers like to do because they like everything to have a very clean thing, but it's not a good idea. Let's do this here. Let's jump to receivables briefly. I'm going to ask you what some of your best ideas are on how to get collections to happen better, your 2 or 3 best ideas. And then we'll close with balance sheets, and then we'll end this particular episode. So when you think about people collecting money that's owed to them, Rich, what do you see as the best ways for business owners that you've given suggestions or coaching tips so that people can collect more of what they're owed faster? What are the concrete ways they can collect more of what they're owed faster?
The best and simplest way to make sure that you collect is to make sure that the people that you're invoicing understand what the terms and conditions are of the product or service that you're providing. So if you're selling a product, it's easy. You sell the product, you get paid. There's no invoicing. But if you're providing something that gets sent over time, where you're providing product to a large big box retailer, or you're providing service to somebody, and usually it's something that's done over time. So you'll invoice for it. And in having a contractual basis and agreement in place with not just the people that you're selling to, that clearly defines what the terms and conditions are for collections, and therefore what the penalties are for not paying on time, which I am a big believer in doing, is not having a clear understanding of what the expectations are, leads to slow collections, it leads to misunderstandings, and it leads to poor financial control management.
I love it. So I've got to have really clear understanding of here's what you're getting, here's what you're paying, payment terms up front. There should be some form of cost of them delaying should be borne by them, penalties, and or maybe you framed it the other way where they lose the discounts they would have received had they paid on time, and you built that in there. I'm going to give you 4 more, I think, that are pretty good. I've always tell people the speed of the invoice.
Right.
I produce the service. I deliver the service. Some businesses will wait to do their invoicing once a month. So if I deliver on the 2nd of the month and I do my invoicing on the 25th, that's almost 20 some odd days that I'm waiting before I then send the invoice. That's going to give me an extra month waiting for my money.
Right.
So just invoicing more frequently. I put down better deposits up front.
Yep.
In businesses, how can I collect money up front? I love the idea of getting all your money up front, then delivering. Maybe that's not possible. Can I get 50%? Can I get 25%? Third, I put down, collect at the point of delivery. Hey, our expectation is I'm delivering this to you now. I'll wait while you get the credit card out. I'll wait while you cut a check. Not always possible, but why not ask? Why not set that expectation up front? And the fourth final one is, Rich, I'm sure you've seen this, which is the business owner who really is uncomfortable asking for money.
Okay.
And he or she waits and delays until now it's 90 days past due, and then they start to try to collect. And I'm constantly telling clients, hey, front load those collection efforts. The time to put the effort is in the first week, the first 2 weeks, the first 30 days, because anything you wait to get paid decreases the odds of you getting paid, and it increases the odds that your customer gets upset with you. Be
Right.
professional and get paid up front. We had a coaching client who ran an IT services business. And Rich, I kid you not, he had close to just a little bit shy of $100,000 of receivables that he was owed for almost a year.
Right.
And when I said to him about collecting that money, he said, well, it's probably too late. And I said, what are you talking about? He said, well, they might be upset with me. I'm like, are you kidding me? Who cares if they're upset with you? You've just worked for a year for free for them. Go ask for that money. And he got about 70% of it. He didn't get 30, but he was going to walk away from $100,000, and that's pure profit. He's paid all of his expenses. Pure profit. Ouch. Any other comments here before we shift over to balance sheet?
Yeah. So the interesting thing is that if you're the business owner and you're uncomfortable with asking for payment, then get somebody else on your team that you make it their job to make sure that, number one, invoices are going out daily or regularly to the people that you're providing a service or a product to. Number two, that somebody is responsible for collections and somebody is reaching out on a regular basis to collect those delinquent accounts. And number three, pay attention to the aging report so that that you're making informed decisions about where you stand on 1 to 30 day payments, 31 to 60 day payments, and so on. That somebody is paying attention to the collection side of the business. Because if we're not invoicing and we're not collecting, then we're starving our cash flow and we can go out of business.
I like what you're saying there about that, having somebody else responsible for it and then making sure that they're really doing that work with following your process. I'm thinking of another client. They ran a medical business. They basically put doctors into hospitals as a staffing service. This particular client, when we first started working with Rich, if you can imagine this, they had $4 million of receivables on a $20 million business those 4 million were over 6 months past due. 4 million, which represented for them, 20% of their receivables were over 6 months, of which 2 million was from 2 customers, just from 2 clients of theirs. And we changed that. What was going on before was interesting. They had somebody who was collecting a team member, but they would only just send emails. They were uncomfortable with asking for the money. And I tell this person, I said, look, you want to know where your profit is? That $4 million represents 2 years of profit for you. Forget anything else you're going to do. This week, you're going to start calling these places and talk to their hospital CFOs, and you're going to ask for payment while you're on the phone. Right. Not this other person. They started doing that, Rich. It was interesting. They got about 2 million of the 4. 2 million of it went into collections and ended up being lawsuits with the attorneys for that. But again, it's just a matter of, we need to follow up, but whoever's doing it has to be willing to actually make a phone call. Go visit them if they need to. Hey, I'll wait here while you cut the check. You have a really nice waiting room here. Can I get a cup of coffee while I'm waiting for you to cut that check right now? I mean, they owe you the money. Just smile and be professional about it, but be persistent. I have a good friend who's a collection attorney, and his comment is that you've heard, people rob Peter to pay Paul. His comment for his clients is, we're going to be Paul. I don't care if they don't pay all of their bills, but they will pay our bills. And I thought that was pretty clever.
That's clever. I like that.
So on the balance sheet, give me 1 or 2 thoughts on the balance sheet of how I can use the balance sheet to more intelligently run my company.
So the balance sheet, it's a place where you want to pay attention to your assets and your liabilities, and we can run our business more effectively if we're making sure that the assets that we have in the business are accurate and timely, and that we're paying attention to the drawdown of cash funds that we have in the bank to pay credit cards and to do all the operating expenses of the business on an ongoing basis. I typically like to see people have a reserve on their balance sheet, at least equal to 1 month of operating costs or more. and at the very least, at least 1 or 2 months of payroll that they can cover for their operating business. So assets are very important. We can leverage the asset base to strengthen the business, and then we can minimize the weakness of the business, the liabilities, by paying attention to things as simple as it is. Where's your debt? What's the interest rate on each line item of your debt, whether it's a credit card or a loan that you're paying, a line of credit that you got, or what have you? The interest rate on that debt is money that you're paying out that you're not getting any valuable function for your business for. So I see a lot of businesses that borrow to finance the operations of the business, and then they get themselves stuck in a cash flow situation where they have no cash coming in and they're highly debt leveraged. So I see scenarios where businesses get into a very tight place. They get into a balance sheet crisis, or they get into a profit and loss statement crisis. And the balance sheet crisis typically comes in where people are highly leveraged with debt and have underplay in their asset value, so they don't have enough to operate the business, and then they get into an over leveraged situation. The profit and loss statement crisis is a little bit of a different thing, but if we're staying focused on balance sheet, leveraging reserves in your assets to finance operations, making sure that you're properly managing and controlling inventory, because inventory is a huge cash flow hit. I have this thing that I like to try to work with manufacturing companies on, having just-in-time inventory. But the other thing with a manufacturing company is there's this whole work-in-progress process that an accountant that's familiar with manufacturing companies will understand the concept of work in progress and how that plays over into raw materials and finished goods that end up on the balance sheet as an inventory item. So the play of manufacturing companies versus, services companies, a little bit different there, but we want to manage liabilities so we don't get the business in trouble from a liability perspective.
You had so much in there. I'm going to try to unpack 4 separate things with what you just said, because they're really good, really important. One was, you talked about these patterns. So, one pattern is a business owner who doesn't take care to have enough of an operating capital cushion. So then they get into a cash crunch, and now they panic, and that causes certain types of decisions in the business that are suboptimal. The second type of pattern that you didn't mention, but I'll bring up, is the opposite. This is the business owner who, mostly caused by him or her not trusting the numbers, it feels unreal. So they leave too much cash in the business. And so now they're not paying it out. There's more risk because it's in the business. It's now subject to some liability of the business. Plus, they're not doing anything with that capital. So those types of patterns. The second thing I'll unpack with you here is, you talked about in your balance sheet how important it is for me to look at, as I look at the liabilities in there, I'm looking, hey, the balance sheet says this is how I have this is a snapshot at today's moment where I have my resources put. The resources could be resources of equity resources like inventory. I put money into inventory, or money might be in WIP, work in process, WIP, or it might be in receivables that I haven't collected. Those are all resources or assets that are in there. And you talked about looking at the liabilities and saying, am I intelligently deploying that? Is there a way I could have that be less expensive? I'll share one more piece with that. I find it's really hard to understand a balance sheet by looking at just one snapshot in time. As of today, January 1st of this year, this is all my assets, all my liabilities. I find that if I can look at this balance sheet, compare it to a different period of time, usually 1 year ago, previous year comparison. Sometimes I'll look at it as the previous month comparison. The change over time, it's like looking at children. It's hard for me to see my kids grow, but when I go away for 2 weeks on a trip with my wife, we do, every year we take a 1-2 week trip, just the two of us, to be a married couple again. I think they come back, I'm like, oh my gosh, puberty strikes again. They're so different. We see the relative change. And I know for you, with your kids that are grown now, especially at some point if and when you have grandkids, the same thing will be true. Right. So when I look at a balance sheet for a client, I always say, give me the previous year comparison here, the previous month comparison for the balance sheet, because it makes it clear. And then the last thing you said, I thought was really, really important. inventory levels. For a service business, pay attention really to, I think service businesses blow it, especially for service businesses that do large projects. They do a really piss poor job of getting the correct type of deposit or retainer up front. So they have all this expense going out and they collect in arrears, and that kills them. But for the manufacturer, the product-based, the physical-based stuff, or services where they use inventory to deliver their service, you're right. I mean, inventory sucks up lots of cash. It's not an expense, so it doesn't reduce my tax liability until the point I actually deliver or deliver the inventory and turn it into product. I've sold it, or I have to write it off for obsolescence or for damage. So I think those are some really important things. Rich, I'm going to ask for one last question here, then we're going to bring us to an end. This has been really a good conversation. Technical and in-depth, but I hope that our audience realizes that they're getting, between us, 50 years of business experiences or more from this. But here's my last question. What are you going to say to the business owner who's a little bit intimidated, whether he or she wants to admit it or not, it's uncomfortable, but they're intimidated or don't really know how to use their financials the right way? What are what would be your early advice for them? Hey, start here. You can do this. What would be your advice, Rich?
Yeah, that's a great question, David. And as I go into my response to that, I would say that with the clients that I work with, I try to give them the very basic fundamentals of a balance sheet as a living document, starts with the business and continues year over year over year. So the history is important. The financial statement represents the health of the business this month. It's a snapshot of the health of the business. The balance sheet represents the health of the business over time. So I try to stay to the fundamental basics and to get the foundational principles, get the business owners educated to the foundational principles of what the information is that's provided, how to use that information, and how to leverage that information to make informed decisions. So the simplest thing that I can say to the business owners out there is, if you don't understand, don't be shy about asking the question. There are a lot of organizations like our organization that has coaching resources that can help educate business owners. So the fundamental thing is ask the questions, educate yourself, become an informed consumer of the information that's being generated inside of your business. That's the best advice that I could give anybody is don't be afraid to ask. There's a lot of resources out there online in your local community. There are a number of organizations that are nonprofit organizations that can help with the same thing. You're going to get different kinds of information from different types of organizations. Don't be afraid to source the information that you need to make the decision.
I love it. Essentially what I'm hearing from you, Rich, is that running from it or hiding from it is the worst thing to do. I don't need to be an expert that I'm the one producing my own financial stuff, because we've talked about why that's probably a bad decision.
Right.
But I do need to know it well enough to use the information to make good choices, good decisions. And early on, if I don't have that fluency, I need to ask the question so I can be a good consumer of my own financial information, profit and loss, balance sheets, aged AR, aged AP, that, et cetera. So I can use that rolling cash flow forecast. So I can make some good choices and decisions in my business, but I have to be good enough to know what stuff means and to ask my staff who does my financial stuff for what information I'm needing from them. I love it.
That's right.
I think that's really important. Rich, I want to say thank you for spending the time with us here on The Business Coach. I had a lot of fun in the conversation. I don't normally get to be, this kind of into a financial conversation, but I think it was really useful. And I think our listeners and our viewers will use this information to make their businesses more profitable. So on behalf of The Business Coach, I want to say thank you for joining us today.
Absolutely. Thank you for the opportunity to share what I've learned.